Welcome back to the Deep Dive. We're your go-to for, well, getting straight to the insights that really matter. Last time we looked at some core ways to fund education, 529s, Coverdell's, Series E bonds, student loans, sort of a long-term planning side. But today, we're shifting gears. We're diving into what often feels like maybe the holy grail. Grants, scholarships, tuition reductions. People see these as free money, and yeah, often they are. But like most things finance, there are rules, specific ones, and crucially, tax consequences. Understanding these is vital, like really vital for smart planning. If you want to skip that surprise tax bill, this deep dive is definitely for you. Okay, let's unpack this. But before we dive deeper, just a quick reminder that this podcast is based on material from Farhat lectures. All content, examples, and explanations discussed here are derived from the comprehensive accounting resources at farhatlectures.com. Whether you're an accounting student, CPA candidate, or professional, visit the website for additional practice questions, video lectures, and detailed support to reinforce today's topic. Special thanks to Professor Farhat for providing this valuable material. So grants first. For lots of people, this is the dream, right? Financial aid you don't pay back, ever. Can you walk us through the main federal grant, the big one?
Absolutely. Yeah, when you say grants, you almost always think federal Pell Grant first. It's a huge source of aid for millions. Its core purpose is pretty specific, though. It's for undergraduate students, people who haven't earned a bachelor's or a professional degree yet.
Okay, undergrads only, first degree.
Exactly. So freshman, sophomore, maybe you're going back to finish that first four-year degree, you could be eligible. And your eligibility is tied to being enrolled in an approved program, a degree or certificate that the Department of Education signs off on, basically making sure it's for legit academic work.
That's a key distinction, undergrads, first degree. And it's need-based, isn't it? So if someone's wondering, okay, how much could I actually get, what really affects that amount?
Great question. And it's less about your grades, really, and more about your current finances and your enrollment status. Several things really move the needle. One, the cost of the university itself. A pricier school could mean a bigger potential grant.
Makes sense.
Two, and this is probably the biggest factor, your demonstrated financial need. What your family can realistically chip in versus the actual cost. Three, whether you're full-time or part-time. Full-time students usually get more.
Right.
And finally, the length of the academic year matters too. Grants are usually per year. But the really fantastic part, like you said, no repayment. It's direct aid, not a loan piling up.
That's just huge for students. Takes a massive weight off. But I've heard there are caveats. This free money isn't totally string-free. What should students know?
That's a critical point. People sometimes miss this. Pell Grants are amazing, but they're not endless. There's a lifetime limit right now. It's 12 semesters or the equivalent. So you need to track that. Your financial aid office can help.
Okay, a limit. What else?
And here's the big one. You have to make satisfactory academic progress, meaning you got to pass your classes. If you fail, especially repeatedly, or if you drop out, you could lose your Pell eligibility for the future. And sometimes you might even have to pay back some of the grant you already got if you withdraw midterm. It's an investment in you, and they expect you to keep up your end.
That makes total sense. Accountability, right? Now, beyond Pell, there's also the FCOG Federal Supplemental Educational Opportunity Grant. How's that different? Is it everywhere?
Right, the FCOG. It's also aimed at low-income undergrads for college expenses, just like Pell. But the big difference is how it's administered. That makes it, less common overall. Pell is mostly direct from the feds, FCOGs. They're managed directly by the financial aid offices at the colleges themselves.
Ah, so not every school even offers it.
Exactly. It depends on the school participating.
So why would a university offer it? Do they have a stake in it?
They absolutely do. And here's where it gets really interesting.
Yeah.
The school has to put some skin in the game. To be in the FCOG program, the school has to apply each year, and they have to contribute 25% of the grant money themselves.
25%. Wow.
Yeah, so if you get a $1,000 FCOG, $250 comes from the school budget, $750 from the government. It gives the university a real incentive, to pick students carefully and support them because their own money is involved.
That is interesting. Makes the school more of an active partner. So, quick recap on grants. Both need-based, no repayment needed. But Pell is federal, FCOG is school-administered with a school contribution.
Precisely. Similar goal, different mechanics.
All right, so that's grants mostly about need, but what if you're killing it academically? Or you're in a specific field? That takes us to scholarships and fellowships, often seen as rewards. But even these rewards, they have tax rules. Critical ones. People assume scholarship tax-free, but not always.
That's right. Scholarships, fellowships, they're usually based on academic merit. like a high GPA, or maybe to draw people into certain majors or research, even athletics. Generally, you need to be in a degree program, and the good news, they can be tax-free. That's the goal, right?
Absolutely the dream. No repayment, no taxes, but I sense a big but coming.
Right.
Where do students get tripped up with scholarship
Okay,
taxes?
here's the big tax trap. Your scholarship might be free money, but it's not automatically tax-free. Big difference. If any part of that money is tied to you doing work, say you're a teaching assistant, research assistant, and the scholarship is basically your pay, then that part is taxable income.
Ah, payment for services.
Exactly. The IRS sees it that way. And beyond that, for the money to be tax-free, it must be used for very specific things. Qualified educational expenses. This means tuition, required fees, books, and supplies that are required for your courses. That's it.
So using it for tuition, textbooks for your nursing program, good, tax-free. But what about like rent, food, a new laptop?
And that's the crucial exception. Room and board, not covered by the tax exemption. Any scholarship money you use for dorms, rent, meal plans, even getting around town, that's considered taxable income.
Taxable, why?
The rationale basically is because you have to live anyway.
Yeah.
The IRS isn't subsidizing your basic living costs just because you're a student.
Makes a harsh kind of sense, I guess.
And laptops. Usually not seen as a required supply like a specific textbook unless the school explicitly mandates it for everyone in the program or a specific course and maybe builds it into fees. So knowing where that line is between qualified and non-qualified, essential. You got to track it.
Yeah.
Or you risk a surprise tax bill. It totally changes how you budget that money.
Hugely important. Track every dollar. Okay, let's shift again. Tuition reduction. Often an employee perk, but the tax side gets tricky, especially moving from undergrad to grad.
You're absolutely right. The rules really change based on your level of study and your connection to the school. For undergraduate tuition reduction, it's usually straightforward, generally tax exempt. This applies if the student is an active employee, a retired employee, or the spouse or dependent of an employee, and it's reduction from that institution.
So, professor's kid gets a discount at the university where the parent works. That discount isn't taxed. Clear benefit for folks in academia.
It is. It's a big perk. Like, say tuition is $20,000 a year. The employee's child gets a 50% break. That $10,000 reduction. Totally tax-free. Helps keep families tied to the institution.
Now, you said grad students. This is where it gets a little more complex.
Indeed. Graduate tuition reduction is where it gets intricate. It often comes down to whether it's compensation for work. General rule, if you're a grad student, TA, RA, where, and the tuition reduction is your only compensation for that job, no separate paycheck,
Yeah.
then that reduction of mine is taxable.
So if the waived tuition is your pay, it's taxed like pay. Okay.
Exactly. Seems fair. But here's the key exception. The way becomes non-taxable. It's
Yeah.
non-taxable if the tuition reduction is in addition to other taxable compensation.
Meaning?
So say you're a grad assistant.
Yeah.
You work, you earn maybe $5 or $10 an hour. You get a regular paycheck for those hours, and that's taxed.
Right.
And on top of that, you also get your tuition reduced. In that case, the tuition reduction itself is not taxable.
Oh, I see. Because you're already getting paid actual taxable money for the work. The reduction is an extra benefit.
That's the core distinction. The IRS kind of says, okay, we see taxable pay here, so the tuition break is supplemental, not the primary payment.
So it hinges entirely on whether the reduction is the payment or if it's just a perk alongside actual wages. Very specific line.
That's it. Summing up,
Mhm.
undergrad reduction for employees' dependents is usually tax-free. Grad reduction. Taxable if it's your only compensation for work, but non-taxable if you also get other taxable pay for that work. Big difference.
These details are subtle, but wow, so important for planning. Easy to make a wrong assumption. Okay, let's pivot to something that really highlights a key difference here. A real nugget of knowledge from the source material. It comes via a multiple choice question about Pell Grants.
Okay, yeah, a common test question is something like, which factor does not influence the amount of a federal Pell Grant to a student? And the options might be, cost of attendance, student's financial need, full-time, part-time status.
Which we already said do influence it, right?
Correct. All those matter. Cost takes the stage. Need determines your eligibility within that. Enrollment affects the payout over time.
So what's the outlier? The factor that surprisingly doesn't count for Pell, and why is that a big deal?
The factor that does not influence the Pell Grant amount is the student's credit score.
That's the aha moment, I bet.
Yeah.
Really clarifies the philosophy behind these grants. Why no credit score check for Pell when it's everything for a loan?
What's fascinating here is that it truly underscores the need-based foundation. It's intentional. It removes a barrier. Pell Grants are purely about financial need, not your credit history, not your borrowing past.
Right.
I mean, think about it. Most undergrads starting out, they don't have much credit history. Or maybe they have a poor score from early mistakes. The government looks at your financial situation for this grant, not your credit report. It's designed to help those with the most need get access, regardless of credit. It really levels the playing field, you know. A powerful statement about access.
That's incredibly insightful, really clarifies the purpose. Opportunity, not credit worthiness. Okay, so let's recap this deep dive. We've journeyed through funding beyond loans, started with grants Pell and FEO. Real free money based on need, with specific rules on admin, even school contributions. Then scholarships and fellowships, often merit-based, but watch those tax rules. Money for work, taxable. Room and board, taxable. Tuition, fees, books, supplies, usually tax-free. And finally, tuition reductions. Nuanced tax rules there, depending on undergrad versus grad, and whether it's your sole pay or an extra perk.
Yeah, and if we connect all these sometimes tricky rules to the bigger picture, knowing them really empowers you. It's not just about getting the funding. It's about optimizing it financially. It's about being informed, making smart choices, turning those potential tax traps into, well, just part of your plan. Understanding what's taxable, what's not, it hugely impacts your bottom line, the real cost of your education. It saves money, saves headaches.
Absolutely. Knowledge is power here, lets you be strategic. And like Professor Farhat says, invest in yourself, and accounting is worth it. We really encourage you to explore more, especially if you're studying for the CPA exam, EA, or just taking accounting classes. Definitely check out farhatlectures.com. Lots of resources, practice questions, support to lock in what we talked about today. Thanks for joining us for this deep dive. Hopefully you feel a bit more ready to tackle those financial aid details with confidence.